The truth about cash flow and the economy during a crisis. In the hustle of daily life, sometimes we wonder, where has all the money gone? Especially when our wallets are empty, markets are bleak, and businesses shut down one after another. Has money evaporated into thin air? Or is it simply lying dormant, waiting to be reawakened to circulate again? In truth, money flow in the economy is just like blood in the human body. When it flows, all parts thrive. But once blocked, the entire system becomes paralyzed. This issue of cash flow isn't just about individual consumers or investors. It is the central mechanism of the entire macroeconomic engine. In Vietnam, where real estate is not merely for living, but also a primary vehicle for investment and wealth accumulation, money flow becomes even more critical. When the property market thrives, the economy breathes. But when it stagnates, cash flow freezes, triggering a domino effect that impacts all sectors and corners of daily life. So where is the money actually going? How does money flow? And why does a supposedly immobile asset like real estate hold the power to regulate an economy's heartbeat? Money doesn't disappear, it silently shifts when the economy enters a downturn. When income is tightened and companies cut back investments, people often feel like money has vanished. Transactions slow, business cools, revenue plummets, and optimism fades. But this isn't because money is gone. In economics, money doesn't vanish, it moves from one hand to another. The speed of that movement is the heartbeat of the economy. For example, someone takes out a $1 billion loan to buy a house. That loan sets off a cascade. The money goes to a real estate company, which then pays the government for land. The government uses it to fund infrastructure. Contractors receive the money, pay workers, who then spend it on consumer goods, feeding it into manufacturing, rewarding managers, and even reaching auto dealers, who reinvest it into real estate again. This single billion dong circulates through 7 different transactions, each generating new value. Although the original sum remains 1 billion, it has created economic value worth 7 billion. This shows the power of money. Its velocity generates GDP. When money moves fast, people maintain their standard of living. Businesses continue operating, and the government sustains growth even when total liquidity isn't high. But when someone holds back money out of fear or caution, the entire cycle is affected. Reduced transactions make it seem as if money has disappeared. This money cycle operates on 2 levels. Micro, how individuals and companies use money, and macro, how the entire system allocates and multiplies value from the same currency. If you buy a phone for 10 million dong, you're not destroying value, you're transferring ownership. The seller uses that money to pay expenses, wages, and reinvest. Each link in the chain continues creating value and contributes to GDP. A perfect example is the post-COVID economic stimulus in the United States. The government printed money and sent direct checks to citizens. Instead of saving, Americans spent the money on electronics, furniture, real estate, and stocks. As a result, GDP rebounded, retail sales soared, and tech giants recorded historic profits. The same dollar can multiply into tens of units of value if it circulates rapidly. This is the power of monetary velocity. Returning to our earlier example, bank loans aren't funded with existing cash but created as credit. This new money only becomes meaningful when it exits the bank and is used to generate goods and services. Every transaction contributes to GDP. Credit is often referred to as the lifeblood of an economy, as it enables production and value creation. In Vietnam, during the 2009 global financial crisis, the government launched a 3,000 billion dong stimulus package, mostly subsidized loans with 4% annual interest. Companies used the funds to invest, expand, and hire. As a result, GDP still grew over 5.3% despite the global downturn. This was artificial money injected at the right time to prevent collapse. But the key issue is circulation. If any link in the chain decides not to spend, the entire system chokes. For example, if a manager receives a bonus, but decides to save it instead of buying a car, the flow stops. The auto dealer has no revenue, the real estate firm can't sell, and economic movement stalls not because money is lacking, but because velocity slows. This is known as a liquidity trap. Between 2023 and 2024, Vietnam's real estate market exemplified this. Buyers hesitated due to legal concerns. Sellers couldn't find buyers. Banks withheld lending and projects froze. Even with liquidity available, money didn't circulate. GDP stagnated, unemployment rose, and non-performing loans increased. So where does the money go during crises? It doesn't disappear. It migrates to safe havens like gold, the United States dollar, government bonds, or rural land. Investors pull out of risky assets and seek value preservation. In 2022, as the Federal Reserve raised interest rates, hundreds of billions of dollars flowed out of emerging markets into United States Treasuries, causing the United States dollar to surge while global stocks plummeted. In Vietnam, when real estate froze, cash redirected to gold or inexpensive land. In late 2023 and early 2024, domestic gold prices surpassed 82 million dong per tael, not due to scarcity, but because capital was seeking safety. Trust is where money flows. Money creates trust, and trust sustains money. The real danger isn't lack of money, but a lack of confidence to use it. A functioning economy relies on a shared belief: if I spend today, I will earn again tomorrow. If I invest, the market will absorb my product. When this belief fractures, spending halts, investments pause, banks restrict lending, and the economic system slowly suffocates. Governments then must act: stimulus packages, public spending, monetary easing, liquidity injections. But if trust isn't restored, the money won't move, or worse, it flows into speculative bubbles, causing further instability. Money can multiply GDP only when it's spent. Circulation, renewal, and utility breathe life into money. Otherwise, it's just a meaningless number. The earlier example of 1 billion dong appearing in 7 transactions wasn't duplication, it was value creation through flow. When money is spent on salaries, materials, services, or investment, it creates economic momentum. But if it stays locked in safes or speculative loops, it's like a wheel spinning in sand, moving but going nowhere. Hence, speed of money circulation is the core issue. During crises, don't ask where money went, ask where it's stuck. Who's hoarding it? Who's afraid to spend? Which sectors lack capital? Are banks willing to lend? Do consumers feel secure enough to open their wallets? If everyone freezes, even a system full of liquidity becomes inert. Money is economic energy. It doesn't vanish, it transforms. When directed properly, it becomes an invisible engine, creating jobs, services, taxes, and wealth. But if blocked by fear, poor credit flow, or policy missteps, money becomes the seed of crisis. Once you understand how money flows, you'll recognize the pulse of economic growth. Whether you're a consumer, entrepreneur, or policymaker, know this money isn't meant to be hidden. It must be used at the right time, in the right place, and for the right purpose. Only then can money multiply value, not just for individuals, but for society. This is the core principle of finance in a truly living economy. Vietnam's real estate story is a prime example. In Vietnam, property is more than shelter, it's a financial reservoir, a value benchmark, and the most popular investment destination. From blue-collar workers to the wealthy, from frugal savers to leveraged investors, the destination is often the same: land and property. Real estate acts as a massive dam, sometimes releasing flow, other times trapping it, and occasionally making it seem like money has vanished. Why is real estate Vietnam's financial promised land? It stems from cultural beliefs and a lack of equally attractive alternatives. The stock market is volatile, bonds are tarnished by scandals, and bank interest rates fail to beat inflation. Thus, real estate is seen as a dual purpose: asset tangible and potentially profitable. In many years, property yields far surpassed all other investments, especially in major cities and adjacent provinces. However, housing prices often defy traditional supply and demand rules. Prices skyrocket even when actual housing needs don't. The driver? Investor expectations. Most buyers aren't looking for homes they speculate, hoard, or fear holding depreciating cash. This FOMO mentality drives prices up, not real demand. As a result, real estate becomes a colossal money magnet. Each price bump attracts more capital. Developers raise billions via bonds, bank loans, or customer deposits, chasing monetary waves toward land. Then the money spreads into construction materials, furniture, labor, logistics, advertising, banking, creating a multi-sector ripple effect that boosts GDP. But when the property market crashes, as it did between 2022 and 2024, the money map turns gray. Buyers vanish, investors retreat, banks cut credit, firms choke on cash shortages, and projects are abandoned. Mass layoffs follow, value chains break, and financial scarcity creeps across society. Consumer behavior shifts. People stop spending and start hoarding. That's why banks aggressively offer loans, not due to lack of funds, but because they can't find borrowers. People hold money but have nowhere to invest it. The issue isn't lack of money, it's lack of viable destinations. Frozen real estate, surging risks, and disillusioned buyers paralyze the system. Consumption shrinks. Businesses hesitate to expand. Credit growth slows and money stagnates, becoming lifeless numbers in bank accounts. This phenomenon is visible in Vietnam. When home prices rise, the economy feels vibrant. When prices fall, gloom sets in. Rising prices revive confidence. People renovate, furnish, and invest. Developers receive funding, banks lend more, and the state earns transaction tax. This is the asset effect. Rising asset values spur consumption and investment. Conversely, falling prices crush more than investor hopes. They drag down banks, developers, and supply chains. Many Vietnamese firms tie their entire fate to real estate. They borrow with half-finished projects as collateral. When values drop, banks reassess, cut lending, or demand repayments. Companies lose liquidity, lay off staff, cancel marketing, shut branches, or collapse. Unemployment rises, consumption shrinks, and cash flow tightens, a dangerous downward spiral. Cases like Tan Hoang Minh, Van Thin Phat, and Novaland's bond turmoil are prime examples. Credit tightening led to market panic. Tens of trillions in bonds became high risk. Retail investors panicked, and hidden capital quietly exited. The result? Widespread perception of financial scarcity, even though total liquidity hasn't changed. When capital is trapped in unsellable assets, the economy begins to contract. Even as the government lowers interest rates, offers tax relief, and expands credit, without restored trust, money remains idle. So what's the solution? Two main paths. First, let home prices fall to new lows, painful but quicker. Some lose, but the market recovers sooner. Second, create alternative financial channels, transparent stock markets, standardized corporate bonds, and fintech investment models. But this depends on one thing: a trustworthy destination for capital. Without one, people will keep holding cash, waiting. And the longer they wait, the more the economy resembles a stalled engine, running out of fuel. Waiting damages economic health. In short, real estate in Vietnam is not just an asset, it is a vital macroeconomic valve. When it flows smoothly, money circulates buyer to company, to bank, to contractor, to worker, and back again. When it freezes, the blockage spreads beyond real estate, choking the whole economy. Every sector feels the absence of money, even though it hasn't disappeared. It is stuck, frozen by societal anxiety. So to revive the economy, we must get money moving by lowering house prices, restructuring debt, or building new investment pathways. Otherwise, the paradox of excess money but no capital will remain. And economic stagnation won't just be a feeling, it'll become a grim reality. I share everything I know about investing, business, wealth, and financial freedom for free. If you found this helpful, consider following my channel and turning on notifications. If even one line today helps improve your life, that's more than enough for me.